Welcome back to the Deep Dive. Today, we are stripping away the shiny exterior of the global economy and looking at the actual nuts and bolts.
Literally.
Literally, the nuts and bolts that hold it all together.
And the turbine blades. Don't forget the turbine blades. And the fasteners. And the wheel.
Exactly. We are talking about Howmet Aerospace. Ticker is HWM. Now, I know what you're probably thinking. Aerospace sounds industrial, sounds slow. But if you checked your portfolio on February 12, 2026, you saw something that looked a lot more like a tech stock breaking out. The stock just popped over 5% right after their Q4 2025 earnings report.
And honestly, it deserved to. We've been combing through the transcript, the press release, the whole slide deck all morning, and what we found, it isn't just a story about bending metal.
No.
It's a story about a company that has maybe accidentally found itself at the absolute choke point of the two biggest trends in the world right now.
The post-pandemic travel boom that just will not quit, and the insatiable energy hunger of artificial intelligence.
It's the ultimate picks and shovels play. Except the shovels are made of these advanced nickel alloys, and they spin at, 10,000 RPM.
So here's the mission for this deep dive. We are going to unpack this report to understand how a company that makes physical hardware is putting up, software-level margins. We're going to look at why your flight is full, why your internet is working, and why the military is buying spare parts faster than they're buying new planes.
It is a fascinating document. Let's get into it.
Okay, start us off. The headline numbers, just how good was Q4?
It was a record breaker. I mean, across the board. For the fourth quarter alone, revenue hit $2.17 billion.
Wow.
And that's up 15% year over year. And if you zoom out to the full year 2025, they brought in $8.25 billion. That's up 11%.
Okay, so double-digit growth, that's solid.
Yeah.
But, revenue is vanity, profit is sanity. What's the bottom line look like?
Exactly. And this is where the report goes from just good to wow. You have to look at the EBITDA, so earnings before interest, taxes, depreciation, and amortization. In Q4, that number was $653 million, up 29%.
Hold on. So revenue is up 15%, but profit is up almost 30%.
30%. Yeah. That is some serious operating leverage.
It is. And it drove their margins to record highs. Usually in heavy manufacturing, if you're hitting a margin in the high teens, you're throwing a party.
Oh, yeah.
Howmet's total EBITDA margin for the year hit 29.3%?
Nearly 30% for a company with factories and smelters.
That's unheard of.
And it gets crazier. If you look specifically at their engine products segment, the part of the business making these really complex jet engine components, they hit a 34% margin in Q4.
34%. That's a software margin. I mean, that's Microsoft territory, but they're doing it with hot metal.
It signals extreme efficiency, sure.
Yeah.
But more importantly, it signals pricing power.
Right.
When you're the only one who can make a critical part for, $200 million airplane, you get to name your price.
And I assume that profitability just translates directly into cash?
Oh, absolutely. They generated a record free cash flow of $1.43 billion for the year. Management on the call actually kept calling the company a cash machine.
I mean, with those numbers.
They're not exaggerating. The balance sheet is pristine.
So let's unpack this. Why is business so good? This has to bring us to our first deep dive. Commercial aerospace. This is their bread and butter, right?
It is. Revenue there was up 13% in Q4. Now, the obvious story is just, Boeing and Airbus are trying to build planes as fast as they can, so they need more parts, and that's true.
But that's not the whole story.
It's not the real story. The real story is what you call the spares phenomenon.
Right.
This is the real aha moment of the report. The real growth engine is, it's inside the engine. Commercial aerospace engine spares, so replacement parts, grew by a staggering 44% for the full year.
44% growth in just spare parts. That seems way out of proportion. Why are airlines burning through parts so quickly?
It really comes down to physics. Think about the engines on the modern jets, like the Airbus A320neo or the Boeing 737 MAX. The big push for those engines was fuel efficiency.
Right. Save money on fuel, be better for the environment.
Exactly. But to get that efficiency, the engineers had to push the thermodynamics. These new engines run much, much hotter and at much higher pressures than the ones from 20 years ago.
How much hotter are we talking?
We're talking about temperatures in the hot section that actually exceed the melting point of the metal alloy itself.
Wait, pause right there. If it exceeds the melting point, why doesn't the engine just melt?
Because of the incredible technology that Howmet provides, they cast these turbine blades with these complex internal cooling channels. They're like microscopic air passages inside the metal, and then they cover them in these advanced ceramic coatings. It's a marvel.
But even with all that tech,
Even with that, the environment is just incredibly hostile.
so the parts just wear out faster.
Significantly faster. The time on wing, which is how long an engine can fly before it needs a major service, is much shorter for these new engines. Durability has become a huge issue for the airlines.
So the quest for fuel efficiency has accidentally created this maintenance gold mine for the company making the replacement parts.
Precisely. It's the classic razor and razor blade model, except the razor blade costs $10,000 and is made of a single crystal nickel alloy.
And on top of that, you have to add in the fact that planes are just flying more than ever.
Right. I mean, if you've flown recently, every seat is full. Airlines are just sweating their assets. They're flying their fleets as hard as they can.
And they can't get new planes fast enough, so they're keeping the old ones in service longer.
Exactly. Let's touch on that backlog because it's so important here. If you're an airline and you order a standard narrow-body jet today, you're likely not seeing it until after 2030.
After 2030.
The backlog is at record levels. Boeing is trying to get to maybe 40 planes a month. Airbus is pushing for 60, but the whole supply chain is just snarled.
So you have no choice. You have to fix the planes you already have.
You have to. And this creates what they call a double flywheel for Howmet. First, they have guaranteed work for the next decade, just building parts for all those new planes in the backlog. That's the baseline.
Okay.
But then, on top of that, they have this exploding business, replacing parts on the existing fleet because the new engines are running hotter and the whole fleet is flying longer hours.
That's an incredible position to be in. But let's pivot, because this next part is what really surprised me. I did not expect to see artificial intelligence popping up in an industrial aerospace report.
This is the hidden gem in the Q4 numbers. It's their gas turbines segment.
Which they used to just lump this in with oil and gas, right?
Correct. But they've basically rebranded it because the end market has completely shifted. The segment grew 32% in Q4.
Okay, 32%. Connect the dots for us. What do gas turbines have to do with the internet?
It's all about electricity. We all know that AI data centers are just massive energy hogs.
Unbelievably so.
Training a large language model consumes an exorbitant amount of power, and the grid is already struggling to keep up. But more importantly, data centers need what's called baseload power.
Meaning it has to be on all the time.
365. They cannot afford any downtime.
And renewables like wind and solar, they're intermittent.
Exactly. The sun doesn't shine at night, the wind doesn't always blow, and battery storage isn't quite at the scale yet to bridge that gap. So what are the big tech companies and utilities doing?
They're turning to natural gas.
They're installing natural gas turbines, which are basically jet engines bolted to the ground.
That's really all they are.
That's it. They spin a generator to make electricity. And just like a jet engine, the most critical, most complex part is that turbine blade spinning in the heat.
And Howmet makes the blades.
Howmet is the largest manufacturer of industrial gas turbine blades in the world. They supply GE, Vernova, Siemens, Mitsubishi, all the big players.
I honestly had not made that connection. You can't have ChatGPT without the physical power plant, and you can't have the power plant without Howmet's blade.
It is the physical infrastructure that enables the digital infrastructure. And management was incredibly bullish here. They expect this business, which is currently about $1 billion in revenue, to double.
Double.
To $2 billion in the next 3 to 5 years.
Doubling $1 billion business in 3 years that's aggressive growth.
It is, but the demand signals are all there, and technically it fits perfectly in their wheelhouse. The technology in these modern gas turbines is actually converging with aerospace engines.
Oh, really?
Yeah, they use similar cooling tech, similar airflow passages. So Howmet is just taking their aerospace expertise and applying it to the ground to power the AI revolution.
Okay, so we have planes and we have power. But unfortunately, the world isn't just vacation travel and chatbots. We have to talk about defense.
Yes. Defense is the third pillar, and defense aerospace revenue was up 20% in Q4. And interestingly, we see the exact same pattern here that we saw in commercial.
Don't tell me. The spares story again.
The spares story all over again. John Plant, the CEO, he dropped a really key statistic on the call. He noted that for the F-35 fighter jet program in 2025, the value of spares demand actually exceeded the value of new builds.
Wait, say that again? They made more money fixing existing F-35s than making parts for brand new ones.
Exactly. The fleet is huge now, and it's being used heavily. It needs constant repair and replenishment. But it's not just planes. The report also highlighted surging demand for missiles, for drones, for rocket motors.
It really does sound like the geopolitical tension is translating directly into hardware orders.
It is. Governments are rebuilding their stockpiles, and looking forward, they briefly touched on collaborative combat aircraft.
Those are the autonomous drones that are supposed to fly alongside the human pilots, the whole loyal wingman concept.
That's the one. And Howmet is already working on the engines for those too, so defense is just another strong, growing pillar for them.
Okay, so we have three massive tailwinds: commercial, AI power, and defense. Was there anything in this report that wasn't a home run? Was there a flat tire anywhere?
There was, and quite literally, a flat tire. The commercial transportation segment, which is mostly just aluminum wheels for big 18-wheeler trucks, that was the one outlier.
How bad was it?
Well, on paper, revenue looked okay. It was up slightly, about 4%. But that was a mirage.
Why?
It was only up because they were passing through higher aluminum costs to their customers. The actual volume, the number of wheels they sold, was down 10%. And for the full year, the whole segment was down 5%.
So is this something to worry about, or is this just a cycle?
The consensus on the call was that it's just a cycle. The trucking industry has been in a freight recession for a while. You know, too many trucks, not enough cargo to move.
Right.
Management believes we're scraping the bottom right now in Q1 of 2026.
But there's a light at the end of the tunnel.
There is a very specific light. New EPA emissions regulations for heavy trucks are set to kick in 2027.
The classic pre-buy effect.
Exactly. Whenever the government announces new rules that are going to make trucks more expensive or more complex, the big fleets rush out to buy the old, cheaper models right before the deadline.
So they expect a big wave of orders to come in late 2026.
A strong recovery, yeah. And I should point out, even with volumes down 10%, they didn't bleed money in that segment.
How do they manage that?
It's that operational discipline again. They flexed costs, which, in plain English, means they cut headcount and tightened up efficiency to match the lower demand. They protected their margins, even in a down cycle.
Okay, let's talk about what they're doing with all this money. Because when you have $1.43 billion in free cash flow, you have options. It really looks like Howmet is in a spend money to make money mood.
Oh, they are being very aggressive. First up is M&A mergers and acquisitions. They agreed to buy a company called CAM, that's Consolidated Aerospace Manufacturing, for $1.8 billion.
And what does CAM bring to the table?
It gets them deeper into things like fittings and couplings. It just broadens their whole fastener portfolio. It's not sexy, but it means they own more of the real estate on every single airplane.
And they also did that smaller deal that I thought was kind of funny, just because of how specific it was.
You mean the Brunner deal?
Yeah, Brunner.
Yeah.
They spent about $120 million on them. And what do they make?
Big bolts.
Big bolts.
Very big bolts. Anything over a 1-inch diameter. It sounds incredibly niche. But Howmet explicitly said on the call they had a gap in their catalog. They couldn't make those efficiently.
So instead of spending 5 years trying to figure it out,
You just bought the best company in the market. We need bigger bolts. Let's just buy the bolt guy. It's efficient.
I love it.
But they're not just buying companies, they are building. Their capital expenditure CapEx was a record $453 million in 2025. They're expanding 5 different plants right now.
And I read something about a brownfield plant acquisition.
Yes, for the gas turbine business. This shows you how high the demand is. They literally ran out of floor space in their existing factories.
I couldn't fit another machine in the building.
No. So in February, they just went out and bought an existing facility nearby a brownfield just to handle the overflow.
That is a very good problem to have.
It is. And inside these plants, they're investing heavily in what they call the digital thread.
This is the automation and AI piece.
Right. At their Whitehall plant, they're tracking every single part digitally through the whole process. They're using AI to analyze the casting process to improve yields. If you can reduce the number of scrapped blades by even 1%, that's millions straight to the bottom line.
Now, usually when we hear automation and AI in manufacturing, the next sentence is about layoffs.
But not here. That's the paradox. Despite all the robots and the digital thread, they are hiring like crazy.
Really?
They added about 1,500 net new employees in 2025, and they announced plans to add another 1,500 in 2026.
Wow. That's a huge signal of confidence. You don't hire 3,000 people in 2 years unless you are absolutely certain the work is there to pay for them.
Exactly. They're not worried about a recession. They're worried about not being able to make parts fast enough to meet demand.
So bringing it all together for 2026, what's the outlook? What is management telling us to expect?
The guidance is very bullish. They're projecting revenue to hit about $9.1 billion. They expect EBITDA to climb to around $2.76 billion, and that free cash flow number up to $1.6 billion.
And there's a pretty big ask on those numbers, isn't there?
Yes, a very important one. That guidance excludes the big CAM acquisition.
Ah.
So if that deal closes mid-year, as they expect, the actual reported numbers could be significantly higher than that.
And for the shareholders listening, what about returns?
They are being very shareholder-friendly. They reduced debt by $265 million, so the balance sheet is just rock solid. They bought back $700 million in stock last year and have already bought back another $150 million in the first 6 weeks of this year.
And the dividend.
They hiked the dividend by about 70%.
So you've got growth, you've got cash flow, and you've got returning cash to shareholders. It's the trifecta.
It's a very clean story. There's not a lot of ambiguity here.
So let's wrap this up then. Howmet Aerospace. It really feels like this company is sitting at this unique intersection.
It is. You have a convergence of three massive global trends. You have the travel boom that's just defying gravity. You have the rearming of the world driving defense spending. And you have this desperate need for reliable power to run the AI revolution.
And Howmet is the bottleneck for all three of them.
That's the key word, bottleneck.
Yeah.
If you need a jet engine, you need Howmet. If you need a missile, you need Howmet. If you need a gas turbine for your data center, you need Howmet.
Because they have the technology.
They have the technology, specifically the metallurgy and the casting tech, that is just incredibly hard to replicate. You can't just spin up a competitor in a garage.
It really highlights something we talk about, which is how we often get obsessed with this software layer of the world. You know, we obsess over the AI code or the airline booking app.
Or the slick interface in a fighter jet.
Right. But none of it works without the physical infrastructure underneath it.
It doesn't. You can write the best code in the world, but if the turbine blade melts, the server goes dark. If the fastener snaps, the wing falls off.
And here's the provocative thought I want to leave everyone with. We look at companies like Boeing or Airbus or maybe Microsoft and Google as the titans of industry. They're the ones with the logos we all see. But if the backlog for a new plane is 5 years long, and if the power grid can't support the next data center without a new turbine, who really holds the leverage?
Is it the company with the brand name on the tail of the plane? Or is it the company making the little specialized metal blade that keeps the engine spinning without melting?
I think Q4 2025 gave us a pretty clear answer.
I think it did.
If you want to dig into the numbers yourself, you should check out the show notes. We've linked the full earnings transcript there. It's definitely worth a read if you really want to understand the plumbing of the global economy.
Definitely.
Thanks for listening to The Deep Dive. We'll catch you next time.